This is our Forex blog for September 27th, 2011. And like most days, we really want to trade the real-time trend and buy the strongest trending currency versus the weakest. You can see the dollar and the yen on the top, which most people trade against the ones on the bottom. We have the real-time statistical strength, which is made up of 5 different statistical trend tools where we statistically compare the dollar to the yen, the euro, the Swiss, and all the rest. 3 of these tools measure direction. One of them measures the intermediate intensity of that direction, and the other one measures the intensity on a bar-by-bar basis. So these are all averaged together and weighted to give you one easy to read, simple, and very, very accurate and fast tool. You can see a couple hours before midnight today, the dollar was very weak. The yen was as well, but not quite as weak as the dollar. Underneath that, we had the intermediate time frame trend, daily trend, which shifted down yesterday afternoon. However, the weekly monthly trend is up, which means, usually you can have an hour to 3 hours and sometimes 8 hours of weakness, but the strength can come back in as people are looking to buy the dips because the longer term trend's up. One of the weakest 2 pairs are the Australian and New Zealand, the weekly and monthly, but today was a counter trend day where they showed incredible strength. So be aware of that. Be very cautious on days where the strongest longer term trends are weak and where the weakest ones are strong. It can last for a couple hours or all day, which you can see for the most part the Australian and New Zealand did. The pound is also one of the stronger ones, but other than just a few hours of intense and occasionally mild weakness, it went back to the longer term trend here at 6:30. So you always have to be aware that that can happen, and oftentimes does happen, especially if the pound's selling off against various currencies and it comes up to a very strong support level. It could be a whole number, previous day's low, previous week's low, previous month's low, weekly or monthly pivot level, Fibonacci area, and so forth. So looking at this today, the dollar and the yen were weak last night. One of the strongest 2 were the Australian and New Zealand. If you're going to trade a currency that's against the weekly and monthly trend, try to trade the one that has the most intensity, above 80, strong intermediate time frame trend, and hopefully if there's a choice between 2 currencies, one of them, the daily trend shifts up or shifts up first. But both of these are about the same strength. So you could have traded and bought the Australian versus the dollar coming up to midnight. You can see when a currency is above the hourly, it tends to go up. You buy the little pullback, small loss, small win. You would have been in this one at 99 and out up here at 72. That's a huge 72 pip profit there on that one. And once they're near the upper containment band, you usually want to wait for a little bit of a pullback. You might have went long here, lost 10 pips, went long again somewhere around here at 47, got out here at 93. So you had about a 40 plus pip profit. And once a currency gets to the upper containment band, usually it kind of stalls and comes back. This one went above the previous day's high right here. And when a currency is above the previous day's high, previous week's high, it tends to be strong. So you might have bought this little pullback here, lost 10 pips, bought this one here, maybe lost 5 pips, waited for it to break out, and you can see it went up about 40 pips. Had a very mild pullback. If you bought right here, it went up another 20 pips. But for the most part, the strong Australian and strong New Zealand, I'd be very cautious in buying these at the high because the longer term trend, as you can see, is extremely weak. This one had an NR7 pattern on here. Anytime you get one of those, it means that the market moved very little over the previous 4-hour period. And usually when it breaks out of that level here, you might have got in there, lost 20 pips, broke out again right here, 22, you're out up here. It went up 50 pips. And when it's above the upper containment band, you really got to be careful in buying this. And most of you would do much better trading this on a range chart, which I'll just bring up real quick and show you. Here's the Australian dollar on a 5 pips per bar range chart, just to kind of give you a comparison. Pullbacks are easier to spot. Earlier today, this one was strong. You can see last night incredible momentum. This is a build your own trend tool, which allows you to create multiple different use multiple different tools of ours with different weights. And here's the weightings I use in this one. I'm always testing and trying to improve the weights and the settings. By combining multiple different directional statistical tools with the bottom two that show intensity, intermediate time frame intensity and a bar by bar intensity, this uses 5-minute bars. Every 5 minutes we measure the intensity of how far this bar moved compared to the last 20 days for all the pairs. And I give that a 30% weighting because intensity is important. Intensity tends to lead to continuations. When you have extreme momentum like this, it means not only is the Australian going up almost against everything, the dollar's going down, but it's also doing so with above average intensity. So, you know, last night you buy these little pullbacks. You can see this one went up about 20 pips. You know, you want to wait for a decent pullback off the high. 10 pips isn't really that much, but you got long here. Maybe you lost 10 pips. It kind of came down and went sideways here. Didn't go any lower. Once that weakness goes away, you buy. You can see it shot up about 40 pips. Again, buying near the high with such a shallow pullback is not a good idea. You get a pullback right here. You know, if it goes sideways right here, you can buy it as soon as it breaks out. All right, you might. It's still weak, so you know you might avoid that trade. You might miss a trade. It went up with less momentum than it did on the way down. If it comes back down and can't break this low with less weakness than it had before, then you can consider buying the 98.60 area. Or if it just goes sideways here for another couple bars, you can buy the breakout. Breaks that over that high, you'd buy. It doesn't, you avoid a loss because you didn't get in it. Price has to prove it to you. Came back down, didn't break the low, has decent weakness, so I'd be a little careful in buying it. Because of the previous strength, you know, this is a 50-50 trade right here. It came up, double topped here, came down, double bottom, couldn't go below that level. It might be worth the risk. 9,900, the previous swing high, is your profit target. You're going to risk about 10 pips to make 20 if it works. And once you get into a trade, let's say you're long here at 83, 84, if you see the momentum go up, you stay with it. If it doesn't, you can try to eke out a few measly pips and get out of the trade, you know, before it turns against you in many cases. Like right here, you can see the momentum isn't at 80 and a higher. You know, if you wanted to get out of half your trade and lock in 2 or 3 pips, or move your stop to break even, or move your stop up so that you only lose 5 pips if you're wrong, that's how you can minimize the damage on trades that don't work, while, you know, being into high probability trades like on decent pullbacks like this that run, you know, 40 or 50 pips. Let's look at the currency meter one more time. Later today, the pound became really strong, and it's strong on all time frames. Over the last couple hours, you know, we had some strength here with the dollar, multiple bars over 80, and this one only had a few peaks of one 5-minute bar with intensity. For the most part, the dollar is stronger than the yen, so when you see weakness coming in both of them, I would pick the one that was less consistently strong before. I would want to trade, you know, a little bit before 7 here, the pound yen. And I'm going to bring up the pound yen on a range chart. This is a 5 pips per bar. And notice incredible strength that continues. Remember, a little bit before 7, the pound got strong, the yen got weak. That's right here. And it exploded up with incredible momentum, more momentum than the last 5 or 6 hours. You buy this breakout right here, and you know, just watch it take off. Your initial stop is just 1 to 3 pips. It's up to you. I usually use about 2, just for a little padding. And when the currency goes up and kind of goes sideways, you want to, you know, lock in your profits, put it right underneath that little sideways range. And when it breaks out, you know, usually it's going to go to the fib target of that wave up. Let me turn this off here. Alright, so it goes to the fib target of the first wave, and typically that's where the market stalls, either at the first or second fib target. So you can see that you're in this trade earlier, right around 119, maybe 10, and you don't get out of it until it goes up to the fib targets. You're looking for it to stall, and it goes sideways right here. So as soon as it goes back underneath that little sideways range around 80, you're out of the trade. You made 70 pips on that trade while risking 10. you know. And using a range bar chart is much higher probability than a 5-minute chart, because if the market doesn't move, you don't have any new bars. As soon as it moves 5 pips, there's a new bar. And so if the market goes up 30 pips during one 5-minute period, you have 6 bars on a range bar chart to really, you know, analyze and see, you know, where it's stalled at, and you can really spot very good levels of support resistance. Now the pound also would have went up against a very weak dollar too. Here's this one. Notice this one also had a pullback earlier today. On the way down, it had a lot of weakness right here, but as it kind of double bottom right here, the weakness was significantly less than the 80 level. And you can also see, you know, very nice trend line patterns on these. Smooth trend line off the top, flat bottom. This is kind of one of those wedge patterns where volatility gets smaller and smaller and smaller and smaller, and when it breaks out, it tends to cause trends. You know, usually on a breakout, if you miss the first one, you can get into the second one. That's the second best trade, and the third best trade is here. You know, once it goes up, you know, it becomes more likely it's going to stall. It may go up one more wave, but most of the time it's not going to go up past the fib target of this. So if you're an aggressive counter trend trader and you miss the move up, you start trading in the US session and it works its way up to the upper band with less than 80 momentum, or it goes up there and double tops, you know, where it has a lot of strength the first time. Imagine this was green. Second time it has a lot less. You can sell the double top. Let's see if it makes another wave up to the fib target. And so this one wasn't even able to get up to the fib target. Once it kind of goes up at least three waves, usually the fourth wave it kind of stalls. You know, this is a very small first wave. Usually and it probably doesn't even show up as a first wave on a 5-minute chart. So, but nonetheless, you can see many good trades on this. Incredible momentum. This is, again, you build your own trend histogram using multiple different tools weighted together into one easy to read pattern. If it's going up and making higher highs and you see plus 80 readings here and you get a pullback, the best trades are when it stays green during the pullback, which sometimes happens. It's a very rare trade. And the second best is what you see right here with very little amount of red, 1/2 to 1/3 the amount of strength. You buy that pullback and you can see in this case, you know, it went up about, let's see, long around 19. You're never going to get every pip. Let's say you get out at 70. You made 50 pips. Beautiful trade. You risk 7 to 10 pips, you make 50 plus pips. And, you know, with those kind of win versus risk ratios, you don't even have to be right half the time. You can be right 30-35% of the time and still make money, because you have huge wins and small losses. Now, not every trade is going to be 50 pips, but you get a 50 pip here, 5 pip there, 15 pip here, 20 pip there, 3 pip here, 25 pip here. You know, it averages out to 15, 20 pips. You're right 50 or 60% of the time. You got small 6 to 10 pip losses. Keep in mind that once trades move your way, you want to move your stop in half. You want to move your stop to break even once it moves 10 pips. So your losses aren't 6 to 10 pips. Your losses might average out to 5 to 7 pips, because you have a lot of break evens and a lot of half losses. And, you know, so you're risking 7 pips on average, maybe making 15 to 20 pips. You're over 50% winning, and that's the key to trading. And our tools help you do that.